In this video, I'm going to show you why the most financially responsible thing you can do, like paying off your mortgage, funding a renovation, or helping a child with a down payment, can accidentally spike your Medicare bill by thousands of dollars. Coming up next on Holy Schmidt.
Holy Schmidt!
You saved your entire life, and you finally touch your 401k, and Medicare sends you a bill for thousands of dollars. How could that be? Here's something that a lot of people don't know. The IRS and Medicare are connected and share information all of the time. And something that you prudently fund with your 401k can come back to bite you 2 years later in the form of Medicare Part B premiums, higher Medicare Part B premiums. Today I'm going to show you exactly how this works, the 2026 actual numbers that you need to stay under, and a two-move fix that most people never learn. Most people assume that Medicare Part B has one premium and that everybody pays that premium. And the fact is, that's true for a lot of people. But there is something called IRMAA, Income-Related Monthly Adjustment Amount. And if you exceed certain income levels, your Part B premium goes up. It's called a surcharge. Here's the thing that most people don't understand. Your Medicare surcharge, IRMAA, is based on your income, not from this year, not even from last year, like your taxes. It's based on your income from 2 years ago. So if you're age 65 and you're applying for Medicare this year, Medicare will look at your income from when you were 63. If you're age 67 and you're applying for Medicare, Medicare will look at your income from when you were 65. And the income, again, is your modified adjusted gross income, Social Security, dividend income, your withdrawals from your IRA or your 401k, and even non-taxable interest from municipal bonds and related types of investments. And your withdrawals from your IRA and your 401k are completely taxable. A lot of people get confused about that because there are other provisions in Social Security, like the earned income provision, where they don't count withdrawals from your IRA or your 401k. Different set of rules. These are the 2026 Medicare Part B IRMAA brackets. The standard premium for Medicare Part B is $202.90 a month per person. That's what most people pay. But once your income crosses certain thresholds, your premium jumps in big steps, not gradual increases. Look at the top tier. A single filer with income over $500,000 or a married couple with income over $750,000 pays $689.90 per month for Part B instead of $202.90 per month. That's $5,844 extra per person per year. For a married couple, that's over $11,600 in additional Medicare premiums, just for Part B, and that's before Part D. But here's the important part. You don't need to be anywhere near the top end to feel the impact of additional income. A married couple that crosses $218,000 in modified adjusted gross income hits the first IRMAA tier. That's an extra $974 per person per year, $1,948 for the couple, from one bad withdrawal decision. And remember, Part D has its own surcharge, so the higher you go up in the brackets, the more you're going to be paying both in Medicare Part B surcharges and Medicare Part D surcharges. Part D is the drug benefit. Let me explain to you exactly how this happens. Meet Dave. Dave is 63. He just retired, and he's got $410,000 in his traditional IRA, and he decides he wants to pay off his mortgage, $120,000 remaining. He wants to go into retirement with no debt. One withdrawal, done, and he's good to go for the rest of retirement. Dave's normal income that year, Social Security and a small pension, is $68,000. Add the $120,000 IRA withdrawal, and his modified adjusted gross income jumps to $188,000. As a single filer, that puts him squarely in the third IRMAA tier when he turns 65 2 years later. His Medicare Part B premium goes from $202.90 to $527.50. That's an extra $3,895 per year for 1 year, all because of a withdrawal decision he made 2 years ago, and candidly, he can't afford to finance the increase in his IRMAA surcharge. And here's the part that makes this worse. Dave didn't need to take the $120,000 out all at one time. He could have paid off his mortgage over 2 or 3 years. He could have sold some stock and stayed under the thresholds. There are a lot of things that he could have done, and He didn't because he didn't know about this issue. Now, this isn't just a generic Dave problem. I see it constantly. We talk about it on my Tuesday 7 p.m. live stream. People will take money out of their 401k or their IRA thinking that they're doing the right thing. They're paying down debt, high interest debt. They think that they're doing something good for themselves. And then 2 years later, the IRMAA surcharge kicks in. A lot of people think this only matters when you first go on Medicare at 65. That's not true. The 2-year look back applies every single year you're on Medicare. If you take a large distribution at 67, it spikes your premiums at 69. Take one at 72 for an RMD shortfall, it hits you at 74. Now, there is a relief valve if your income subsequently drops significantly. A divorce, death of a spouse, retirement. There are several situations where you can contest this. It's called an IRMAA appeal. It works, you can do it, but you need to know that it's available to you. There's also a window where it doesn't matter at all. If you're under age 63 and you have a large income surge, well, you're not taking Medicare until you're age 65 anyway, under most circumstances, and people who do Roth conversions will do them early so that they avoid the IRMAA surcharge. Gang, speaking of Medicare, when you watch this video, it's obvious that Medicare can be confusing. It can be overwhelming. People who turn 65 and make their choices often make the wrong choice simply because they have too much information that they need to go through. Someone will do all of that work only to find out that they made the wrong choice, and it costs them hundreds, if not thousands of dollars a year in additional medical costs. Now, on this channel, we have 3 affiliate relationships. One is our trusted Medicare Partner Chapter. Chapter is the only national advisor that looks at and recommends every plan. They're totally free to you. They save their clients an average of $1,100 per year, and they're very easy to work with. It takes about 20 minutes of your time. If you have an interest in speaking with them about your Medicare, give them a call at 440-703-1224 to see if they can help. All right, let's talk about how to fix this problem, because there is a fix, and there is a 2-solution fix. You can use them together or you can use them separately. Number 1, spread large withdrawals across multiple years to stay under IRMAA thresholds. Instead of taking $120,000 like Dave did, take $40,000 a year for 3 years. This is often enough to keep you underneath the IRMAA thresholds, or at least push you down in the thresholds so that you're not paying an exorbitant premium. The mortgage still gets paid off, but it becomes a 3-year plan instead of a 1-year plan. The second option is to fund your withdrawals through your taxable brokerage account. Now, a taxable brokerage account has 2 big advantages. The first is long-term capital gains. If you have low enough income, your long-term capital gains could be 0%. And the second is that you have a stepped-up basis. Now, what do I mean by that? You're not selling $100 out of your IRA and claiming $100 of taxable income. If you bought an investment for $70 and you sold it for $100, the only income that is even considered is the additional $30 because you funded your brokerage account with post-tax dollars. You bought that investment, that $70 investment, with money that you've already paid tax on. And Roth IRA withdrawals are even better. If you fund that one-time purchase with a withdrawal from your Roth account, that is invisible to Medicare. So you don't have to even consider it in the calculation of your modified adjusted gross income. This is especially powerful if you do Roth conversions before you're age 63, because even if you're recognizing tax on those conversions, that's before the time that Medicare starts looking at your income. And the order of operations matters enormously. Floor expenses get covered by Social Security. Medium expenses come from your brokerage or Roth, and large pre-tax withdrawals get spread across low income years before Medicare starts, or are carefully managed in small increments once you're on it. Now we're going to talk now about my 2 favorite twin brothers, Callum and Marvin. Callum and Marvin have the same investment portfolios: $900,000 in a traditional IRA, $410,000 in a Roth, $205,000 in a taxable brokerage account. Both turn 65 in the same year. Both need $40,000 for a home renovation. Same need, very different approaches. Marvin pulls $40,000 from his IRA, and he has a Social Security payment of $32,000, so his modified adjusted gross income is $72,000. He's still under the first IRMAA threshold as a single filer, and he's fine this time. And then next year, he needs a new roof, another $28,000 from his IRA. Total modified adjusted gross income that year, $60,000. He's still fine. Then at age 67, he needs $80,000 for a major health event not covered by Medicare. He pulls that money from his IRA. So his modified adjusted gross income jumps to $112,000. 2 years later, at 69, his Medicare Part B premium is $284.10 instead of $202.90. That's an extra $974 that year. And he can't get that back. Callum pulls the $40,000 from his taxable brokerage account. His cost base is close to the current value, so therefore he has minimal capital gains. His modified adjusted gross income barely moves. And at age 67, for the major health event, he pulls from his Roth. So his Medicare Part B premium doesn't change. It's still $202.90. Same expenses, same type of portfolio, but zero IRMAA surcharges. Your 401k and IRA withdrawals count as ordinary income. Medicare looks back 2 years. If your withdrawals push your modified adjusted gross income above the IRMAA thresholds, your premium jumps in big steps, not gradual increases, for as long as your income stays elevated. The fix is simple, but requires planning. Spread large pre-tax withdrawals across multiple years. Use Roth and taxable brokerage accounts for one-time expenses. Do your Roth conversions before Medicare starts, not after. And if you do get a charge, know that you can appeal it if your income has since dropped. Gang, if you're making big decisions about Medicare, give our partner Chapter a call at 440-703-1224 to see if they can help. There are a lot of these situations that they run into, and they are really good at helping their customers achieve the best possible outcome. Also, if you like this video, check out that video, How to Pay Zero Taxes on Social Security. This is Jeff Schmidt, and I will see you in that video right there.